In 1930, the United States was crumbling. The stock market had crashed the year before. Banks were failing in waves. Businesses were collapsing. Unemployment was rising toward levels the country had never seen. For millions of Americans, savings disappeared almost overnight. The Great Depression did more than destroy wealth. It destroyed confidence. Entire families lost trust in markets. Investing became associated with recklessness. Speculation became something dangerous. That was the environment Warren Edward Buffett was born into in Omaha, Nebraska. He did not grow up during a bull market. He did not grow up watching easy money being made. He grew up in a world where money represented stability and security, and where losing it carried real consequences. That psychological backdrop shaped him long before he understood it. His father was a stockbroker who later served in Congress. So, while the broader country feared markets, Buffett grew up around conversations about them. Financial statements, stock prices, business cycles, these were normal topics at home. But what stood out was not exposure, it was curiosity. As a child, Buffett showed an unusual interest in how money worked. At 6 years old, he began selling chewing gum and Coca-Cola door to door. He would purchase 6-packs and sell the bottles individually at a small markup. The profits were minor. The lesson was not. He was experimenting with margins, testing how small differences between buying and selling prices created value. He was learning that money was not static. It moved. It could be directed. At 11, he bought his first stock, 3 shares. Shortly after buying, the stock price fell. For a child, that experience could have created fear. Instead, it created tension. When the price recovered slightly, he sold, relieved to escape without loss. But then the stock continued climbing, far beyond where he closed. That moment embedded something important. The mistake was not buying the wrong company, it was selling too early. It was impatience. He later described this as one of the defining lessons of his life. The market tests temperament more than intelligence. The ability to endure temporary discomfort often separates long-term success from short-term reaction. By 12, he had taken on a newspaper delivery route. What makes this relevant is not that he delivered papers, but how he approached it. He tracked which neighborhoods tipped consistently. He optimized delivery paths for efficiency. He expanded routes strategically. He understood that time and effort could be organized for higher returns. By 14, he had saved enough to purchase farmland, which he leased to a tenant farmer. That step marked a shift from earning income to owning income-producing assets. He was no longer just working for money, he was deploying it. After high school, Buffett pursued business education seriously. He was rejected from Harvard Business School, an event that might have redirected many careers. Instead, he enrolled at Columbia Business School to study under Benjamin Graham. Graham's philosophy was disciplined and analytical. He taught students to calculate intrinsic value, to insist on a margin of safety, and to separate price from worth. Markets, in Graham's view, were emotional in the short term, but rational over time. Buffett absorbed these ideas deeply, but he also added something of his own. Graham's approach often focused on statistically cheap companies, sometimes businesses that were undervalued. Buffett began to see the advantage of owning high-quality businesses at reasonable prices, rather than mediocre businesses at deep discounts. That evolution would define his future strategy. After graduating, he briefly worked for Graham before returning to Omaha. This decision was critical. By staying away from Wall Street's daily intensity, he built a structure designed for long-term thinking. In 1956, he launched Buffett Partnership Limited, with 7 partners and just over $100,000 in capital. The structure was clear. He would take a share of profits only after exceeding a defined rate. Losses would reduce his compensation. Incentives were aligned. Over the next 13 years, the partnership significantly outperformed the broader market. He identified undervalued securities, invested heavily when opportunities were compelling, and held positions with conviction. But the pivotal transformation began in the early 1960s. Buffett started purchasing shares in Berkshire Hathaway, a struggling textile manufacturer. At first, it fit the traditional value investing mold. The company appeared cheap relative to its assets. However, the textile industry was seriously declining. Competition from overseas producers was increasing. Margins were thin, capital expenditures were constant. After a disagreement with management over a share repurchase price, Buffett decided to take control of the company entirely. He later acknowledged that this decision contained an element of emotion. The textile business continued to deteriorate. At this point, many investors would have doubled down on operational fixes. Buffett did something different. He treated Berkshire not as a textile company, but as a corporate vehicle. He began acquiring insurance businesses, most notably National Indemnity and later Decode. These acquisitions introduced a powerful concept into the structure: insurance float. Float represents premiums collected before claims are paid. In effect, it is capital held temporarily by the insurer. Float can be invested at attractive returns while costing little or nothing. Buffett recognized that float, when managed carefully, functioned as a form of leverage without the same fragility as traditional debt. This was the moment he transitioned from investor to capital allocator. Instead of simply selecting undervalued stocks, he now controlled a growing pool of investable capital that could be deployed into entire businesses. He began purchasing companies with durable competitive advantages, strong brands, predictable cash flows, and pricing power. Coca-Cola, American Express, The Washington Post, BNSF Railway, energy infrastructure, industrial businesses. Berkshire evolved into a decentralized empire. Subsidiaries operated independently, while capital allocation decisions were centralized. Profits generated in one business could fund acquisitions in another. This internal capital market gave Berkshire flexibility few others possessed. Over decades, compounding magnified the effect. By the 1980s and 1990s, Buffett had become widely respected, but his approach remained unchanged. He avoided excessive leverage. He avoided speculation. He ignored technology bubbles he did not understand. During the dot-com boom of the late 1990s, he was criticized for being outdated. Then the bubble burst. The companies built on speculation collapsed. Businesses with real cash flows endured. The discipline that once seemed conservative proved resilient. In 2008, when the global financial crisis struck, liquidity evaporated. Institutions that relied on short-term funding faced collapse. Confidence disappeared. Berkshire Hathaway, with its strong balance sheet and disciplined capital structure, had flexibility. Buffett invested billions into Goldman and General Electric under terms that provided downside protection and long-term upside. These were not opportunistic gambles. They were calculated allocations during moments of systemic fear. By this stage, his influence extended beyond portfolio returns. Markets watched his moves as signals of confidence. Today, Berkshire Hathaway oversees assets exceeding $1 trillion. It owns dozens of operating companies and large stakes in publicly traded businesses. But the structure is the real story. It is a machine built for longevity, permanent capital, disciplined underwriting, decentralized operations, centralized allocation. And at the center of it all remains a man who still reads for hours each day, who still avoids noise, and who still approaches decisions through arithmetic rather than emotion. The boy who once optimized paper routes for efficiency eventually optimized capital flows at a global scale. The scale changed dramatically. The principles did not. He did not take over Wall Street through spectacle. He did not build influence through prediction. He built a structure that rewarded patience, discipline, and long-term ownership. Over time, that structure compounded into dominance. The paperboy did not set out to control the financial system. He set out to understand how it worked, and over decades, that understanding became power.